Hey, good morning, everyone. Good morning.
Good
Hey, good
morning.
morning. Morning, darling. Good morning, Kasuki. Good morning, Yang. Good
Good morning,
morning,
Professor.
Randy. Morning, Angel. So, finally, the last day of class, the last day. So we have just a couple of things left. So, um, now in our, I want to, okay, so of all the valuation models, right? We have, uh, so this is the Excel file posted in our topics folder, right? Uh, I hope you have already downloaded this. Um, so there are four stock valuation models, right? Basically, these models are all about models to find the intrinsic value, but they um, they work under different assumptions, right? The first one was zero growth model or constant dividend model. Second one was constant growth model, also called Gordon growth model, right? The third one is the variable growth model. So, what is variable growth model? Um, so, variable growth model assumes that the growth rates of dividends, but think about it, that's growth rate of earnings as well, because dividends come out of the earnings, right? EAT. So, growth rate of dividends varies or changes over time. Um, so uh, unlike model number one and two, and in model number one, no change in growth rate, and it's zero growth, therefore constant dividend. Um, and a second one is based on the assumption that the growth rate is constant. But the third one seems more realistic, right? Because in reality, now let's think about it. Let's take a look at okay. Here's the a very famous theory called the product life cycle theory, or also called industry life cycle, right? I mean, it can be just about a particular product, or it can be extended to the whole industry. So I must be sharing my screen. So everyone is looking at this graph, right? Is everyone looking at this graph?
Correct.
Yes.
Okay, good, good. So now let's take a look at, um, first, let's take a look at this green curve. We have green curve and red curve. The green curve represents innovative firm, innovative. Okay, it says innovating firm. But what it means is actually a firm that came up with an innovative product. Okay, so the product itself an innovative one. Um, and I mentioned this briefly in our last class. Innovative product means a product that has never existed before. It's different from uh, simply a new product, because a new product can mean the same old item, but just brand new, just newly made, right? But innovative means, it's a new product that has never existed before. So in that sense, we can use, smartphone as an example. Smartphone was really an innovative product, because there was cell phone, just mobile phone previously, Uh, and even the mobile phone was not around even before 1990s. I mean, there was a very primitive cell phone back in 1986, if I remember correct. There was a car phone, but having a phone in the car was already a very innovative idea uh, in early 80s. Only, you could only see um, some, secret agents using like CIA, MI6 using a um, uh, 007, James Bond, using a phone they carry in a briefcase. That was a very primitive, but they were more like, rather than wireless, they were more like radios, I believe. But then, uh, first mobile phone came out in, I remember the first time I saw it was in 86. It was, but it was almost like a status symbol. Status symbol. Why? Only, uh, some, corporate executives were issued those phones and they were carrying it. And I saw it in the airport because, they were using it in the airport as if it was their status symbol. But anyway, by the 1990s, cellular service, the mobile service, became widespread. So from around early 1990s and mid 1990s, uh, cell phones became quite widely used. But only from 2007, the mobile phone, the smartphones with touch screen, right, uh, which is nothing new these days. But it was the first phone was Apple, of course. First smartphone was Apple, and that was a very innovative product. But of course, so the forerunner, Apple was the forerunner. So innovating firm is, in a way, you can call it a forerunner. And then uh, the late arrivals, or late second runners, or what should I call it? Late runners, late arrivals in the smartphone industries were, of course, then Samsung Galaxy, and then I think that's pretty much it. There was no other at the time, at the beginning. There were no other competitors. But think about it. When iPhone came out in 2007, for a brief period, for about 2 years max, iPhone was the only smartphone, maybe 1 year. And then during that period, Apple had a complete monopoly. And of course, it was born out of research and development, and then during that period, it takes off because no other company, no other competitors. So it was the only company, and so its revenue, sales revenue, takes off like almost in an explosive pattern. I explained the difference previously. I explained the difference between, maybe I better use another one. Oh, it's the same thing. Okay. Previously, I talked about the difference between different types of growth patterns. What is meant by, okay. So for example, if the horizontal axis is quantity, and if vertical axis is the total revenue, right? Revenue. And there can be three patterns of growth, right? This type of growth is constant, right? I told you. And then this type of growth is exponential or explosive growth, right? And then this kind of growth is decay, right? Showing decaying pattern. Why is this called? Why is the green one called exponential? Because as you can see, the slope of this curve represents rate of change, right? And the rate of change is getting steeper and steeper. The slope is getting steeper and steeper. That means, for the same, right? For the same magnitude of change in, for the same magnitude of change, the horizontal change, the vertical change is, look at the, the only, right? Revenue is, so look at the vertical growth. We can tell for the same magnitude of, right, change in horizontal axis, the magnitude of change in vertical axis is much higher. Much greater. So the rate of change is getting higher. Everyone understands that the slope is basically what? Slope is
growth rate.
Growth rate, and it's the change in rise over change in run, right? For how much you ran, right? How much did you rise, right? So in the exponential case, right, the slope or the growth rate is increasing. But in the constant case, it is always constant, the same growth rate. But then in case of decay, the growth rate is declining over time. That's why it's called decaying pattern, right? But based on that, take a look at this, the pattern or the pattern of the curve. The green curve, there is a reason. You might think, was that just a fluke or was it just by chance? Why does it show this? It's, I should say, it's convex in a way. If you extend this, and if this curve is nicely, let's say, replicating itself, right? The right-hand side, replicating right-hand side to the left-hand side, right? It will show like a curve, a quadratic curve with, ignore this part, but just this part. It will show like a quadratic curve pointing, pointing down, right? That's called, convex. So you might think, why is it curved that way? This curve looks natural, but why is it curved? It was intentional. It wasn't by coincidence. It wasn't by any coincidence, right? This pattern is representing, right, exploding growth, right? So early on, when there is no competitor, and when um, the innovating firm has a complete monopoly of the market, their growth is exponential. But in the second phase, stage two, the competitors enter the market, and as the competitors enter the market, the growth slows down because obviously the sale won't be as much as before. It slows down, right? First it was fast, then it slows down, and then it reaches a plateau, right? It will reach a plateau at some point. And at plateau, the growth rate is zero. And then after a certain, once it reaches the plateau, then uh, it declines, right? So the growth rate will be negative. But look, when we say stage one, stage two, stage three, stage four, those stages are um, divided by the whole pattern in the industry, not just one company. Because look, the innovating firm, the green curve is already in decline, right? When it is in maturity stage, but um, how can it be a maturity? I mean, when it is, declining. So the maturity here doesn't mean the maturity of the green curve, uh, but the innovating firm only. It means the maturity of the entire industry, because in that stage, then, right, in stage two, which is growth, uh, it's the growth of the industry, right, not just the innovating firm. And stage three, it reaches maturity. In other words, the industry reaches the maturity, not just a single firm, right? And stage four goes into decline. But again, decline decline is optional. It's um, a company can uh, if they don't reinvent the wheel, right? I mean, if they don't, how should I call it? If they don't upgrade their product, right? Uh, then they will get stuck and they will go into decline. That goes without saying. But if you think about Apple or Galaxy, they are not going into decline. They are still, um, they haven't even reached the plateau, because they are upgrading their phones, right? They're putting out new models every, almost every year, or every other year. So decline can be avoided, right? It can be prevented because they don't want to go into decline. But a good example of this pattern is like video cassette recorders, right? Video cassette recorders. Um, some of you may still find, video, VHS video uh, recorders, players and recorders. You may not own it, but your grandparents may own it, right? Or if you go up to if you are living in a house and if you go up to your attic, you might find still VHS um, video players. And think about it; those video players in the early days, even in the 80s, there were two competing models, Betamax, two competing technologies, Betamax and VHS, and Betamax lost, right? uh, Out of the competition. They lost the competition. VHS was the standard technology. And then even VHS, uh, then it went into decline because then DVD players came out from around late 1990s. VHS video players were no longer in demand. or they were no longer produced because the market switched from video player, VHS video player to DVD. And the market went into decline but the companies didn't go into decline because the companies that were making VHS video players, they simply adopted um, uh, DVD, adopted to adopted new technology, DVD players, and they were the same companies made basically DVD players. So the companies didn't go into decline, the industry didn't go into decline, but those products uh, went into decline. Okay, so from this we can tell, it's more realistic to assume at least there can be four different phases. First, exponential growth early on, and then constant growth. This range is relatively like growing at a constant growth, and plateau where growth rate is zero. So fast growth, slow growth, zero growth, and negative growth. But think about it. Only fast growth and slow growth are relevant, right? Because if you are an investor, nobody will invest in a company that is not growing or showing negative growth, right? But anyway, this is the basis of the variable growth model, because clearly the reality is that no company grows all at constant rate. So, but to apply variable growth model, it's actually just application of Gordon growth model. Why? Because it's just breaking it up into 3 steps. Step 1. First, we find the sum of the present values of the dividends during the fast growth period. G1 is the fast growth period, right? Growth rate during the fast growth period, which is not a difficult thing. We only need to find present values of all the dividends. And then step 2, find the stock price at time n, which is at the end of the slow growth period, and we can find this stock price at time n by using Gordon growth model, because once the fast growth period is over, then comes the constant growth period, right? And then the constant growth period is assumed to last for the foreseeable future, okay? And then step 3, we combine the two. So think about it. This is not S0, it's Sn. That's the price of the stock at time n. Time n is the end of the fast growth period, right? So let's take a look at the example, right? This example. Let's take a look at this example. So I want. I think this is our example. So I want. Okay, before. Okay, so here let's the most recent annual dividend payment of Warren Industries, a rapidly growing boat manufacturer, was $1.50 per share. Was $1.50 per share. The firm's financial manager. So first of all, it says the name of the company doesn't really matter, right? We can call it just Company X. We don't really need to, but this is important. Rapidly growing boat manufacturer. It's growing rapidly currently, right? It's growing rapidly. It was $1.50. So that means, there's a rapid, you can already anticipate that there is a rapid growth period. And then after that, constant growth period or slow growth period. So that was $1.50 per share. The firm's financial manager expects that these dividends will increase at 10% annual rate, G1. And I put G1 there. In most, examples, most problems, they would make that distinction like G1, G2. I mean, it's your responsibility. I mean, it's your ability to make that distinction, right? It's up to you to make that distinction. You have to. Not, but it helps to make this type of notation, because just the verbiages are not really clearly demarcated, right? There's a reason why we use bullet points. When we use bullet points, right, it makes our lives easier instead of just paragraphs after paragraphs, right? And in this case, okay, let me use it. Let me use this space. Think about it. We can say, one, dividend at time 0. Most recent. That means that's the time 0, right? $1.50. 2. Growth rate 1 for the next 5 years, right? 10%. Then, like bullet points, then first a fast growth period T1, 5 years. Okay, this way, by summarizing it by bullet points, you can analyze the problem instead of, so verbiage, I've been saying this over and over. Verbiage is really, really, inefficient way of conveying the information, because if you can read this and already organize in your mind this structure, right, then it's good. Otherwise, it's just a bunch of words, just making it just cloudy, right? So it's your job, it's your ability to the fillet the fish. You have to separate the bone from the flesh, and you have to separate the flesh from the fat, and throw away the fat, which is useless. Next, over the next 3 years. So okay, that was 3 years, right? And then at the end of 3 years, the firm's mature product line, when they say mature, that means, now then they are going to grow at a constant rate. Mature companies, fully mature companies don't grow, right? Mature companies grow at relatively slow, constant rate. 5% per year, which is G2, for the foreseeable future. Now, the foreseeable future is an expression that means, almost same thing as indefinitely, because as far as we can project, right? As far as we can forecast, we can only forecast only into as far as foreseeable future. Beyond that, we can't, right? So foreseeable future is, in other words, it means indefinitely, as far as within our time horizon. Okay. The firm's required return is 15%. So summarize, right? A few of the things. G2, 5%. Now the growth rate is slower, clearly. My handwriting is, please bear with me. My handwriting is not really. And number five is what? Required return. The firm's required return is 15%, wasn't it? 15%. Yeah. So then, based on that, let's work out this model, right? First of all, I built it in Excel, so let's do it this way. So if you have opened this, these highlighted cells are already filled in, but I want you to clear out all the highlighted cells. Okay, so did you clear out all the highlighted cells? Delete all the highlighted cells, please. And if you're ready, okay, so let's go a little fast. So time 0 is end of 2012. Time 1 is end of 2013. And at time 0, it was $1.50, and it grows at 10%. So all we need to do is simply this times 1 plus 10%, right, raised to 1. You might wonder, do we need to do that? Is it necessary? No, it's not necessary, because when you raise it, when you raise something by 1, it's just itself. But this gives uniformity and consistency to our model, because I'm going to drag it down, right? So think about it. To drag it down, then a few things must be locked. So hit C27 must be locked. You'll lock it. D27 must be locked too. Hit F4. And when they are locked, now you can drag it down, right? Then at the end of 2015, dividends should be $2, right? Now we find the present value of all these dividends, right? Present value of all these dividends. We know all we need to do is simply divide it by, discount it, right? Divide it by, where is our, the required return, 15%, right? And we lock it because I'm going to drag it down. We lock that, F4. Okay, and then raise it to 1. Okay, and then if I drag it down, then it gives me all the present values of those. And we're going to sum all those present values, which is not a difficult thing, just okay. Those for $4.12. Those are the sum of all those present values of all those dividends for the next 3 years. And in 2000, and then from 2016 it's going to go into slow growth, constant growth phase. So then from 2016 we can use Golden Growth Model to find the present value at the end of 2015, right? Because the constant growth starts from the beginning of 2016, right? Which is the end of 2015. So to find a stock price as of the end of 2015, we need to use Golden Growth Model. To use Golden Growth Model, we need dividend at time t plus 1. Now, for the slow growth, for the slow constant growth period, for the constant growth phase, right? End of 2015 is time 0. So we need dividend at time 1, right? To use Golden Growth Model, which is not a difficult thing. We already know dividend at time 0 was that. So we multiplied by 1 plus growth rate 2, right? And that's going to be the dividend at time t plus 1. In other words, dividend in 2016. That's going to be the dividend in 2016. And once we know that, then all we need to do is, okay, dividend, this is dividend at time t plus 1 divided by, open parenthesis, r minus g. Okay. Remember Golden Growth Model, right? Golden Growth Model. I already, oops. Right? This is why I did, dividend at time t plus 1 times 1 plus g. And then, now this is not the end, because this is the price of the stock at the end of 2015, right? Or at the beginning of 2016. So we must bring it back to present, which is 2012, right? So we need to discount it 3 years back. So then present value of this stock price will be discounted by 1 plus r, and we discounted 3 years back. Right? Which is what? We know it is 3. We can do this. Alternatively, we can do this. Will give us 3. Right? We need to bring it back to a time 0. There you go. Then, so this is the present value of the stock at the end of 2015, and we have the present value of all the dividends from 2013 through 2015. So we must add them up. So here it's the sum of these two numbers. Okay, and enter 1790. Okay, that's the price of this stock. So let's take a look. Compare it with the okay. So blah 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 17.93. They came up with 17.93. So 92 17.93, 7.90. That's due to, right? This is due to rounding. I mean, the correct, think about it. The stock price at the end of 2015 is 20.96, but they used, they simply rounded, right? So it came to 21. But, considering the rounding difference, this is, the same answer. Okay. All righty. Did everyone get the same result? Did everyone do this exercise with me at the same time? Hmm?
Yeah.
Okay,
Yes, Professor.
only one person.
Yeah.
Everyone got the same result? All righty, so I will have to assume that you did. Any questions? Any questions? All righty, next. So I should have, when I posted it, I should have deleted all the highlights, but somehow I didn't. I forgot to do that. But that's okay. We'll delete. Okay, so we'll delete this. Everything we'll delete it. So next one is free cash flow model. Now this will take some time, but I have to. What is free cash flow? And as I said, some companies don't pay dividends, so then in that case we have to use free cash flow model. And what is free cash flow? First of all, free cash flow is actually not that liberal concept. It's not that free concept. It's not that free. But so where did I put the? So free cash flow, a definition of free cash flow is actually operating. So I will have to open another file, but free cash flow is basically operating cash flow minus investing in operating capital. Okay, so I think I should open. No, not this one. Where did I put it? Chapters. And I believe I put it here. Okay, here's the definition of free cash flow. Now, all those verbal definitions are all garbage. Verbal definitions are garbage. No matter what, verbal definitions are garbage. For those who do science and engineering, math, science, and engineering, all definitions must be mathematical, right? And economics and finance are not exactly STEM, but it is also based on math, so it's close. Now, verbally, they say cash generated beyond reinvestment needs and free cash flow, beyond reinvestment needs. maybe this is not necessary. Or okay, that's better. Net cash flow, and it is net cash flow also. Net cash flow less. Hmm. Okay, I'll have to find. Okay, it's not giving me. It's no longer giving me that thing. But you know what it is. I'll probably, if that symbol's not there, I'll just say, yeah, less. Also, it is defined as net cash flow minus non-operating cash requirements. So what is that? So in other words, that all comes to this: operating cash flow minus investment in operating capital. So what is operating cash flow then? Um, you remember operating income, right? Operating income. How is operating cash flow different from operating income? Um, Operating income is the also called EBIT, earnings before interest and taxes, right? Uh, so when from the income all the expenses are subtracted, then there's EBIT, or operating income, or operating profit. Well, how is operating cash flow different? Well, from that you have to subtract taxes. You have to subtract taxes and add in depreciation. Add back depreciation. Add back in depreciation. Add back in depreciation. Now, why? First of all, EBIT is not entirely uh, uh, the EBIT is less than the actual cash flow. First of all, taxes you cannot touch it because it belongs to the government. So you have to subtract taxes. Depreciation is actually a non-cash layout. Um, if you go back to the um, maybe in FNB 100 there was no uh, way, no time for that. But depreciation is actually a hollow shell, hollow expense account, right? So it's a hollow shell, and I don't have time to explain it. But if you go to, I've been telling you, you can I have YouTube channel, and in the YouTube channel, okay, everything that has been everything is there. I mean, CUNY, BMCC, FNB100, all the videos are there. So at some point, financial statements. Oh, not here. To FNB 230. Well, it's everything. Tax. So it must be in one of these financial statements 1, 2, 3, where I discussed what the depreciation does. I mean, it's also in our lecture, in FMB 100 lecture. So depreciation is actually what they call non-cash outlay. What does that mean? No cash was actually spent. Okay, no cash was actually spent during that period. During that period. So actually, but it is entered as expense. So during that period, that much cash is preserved. Was someone trying to say something? Or was it just echo? So depreciation is cash preserved. It's not cash actually spent during that period. It was spent a long time ago. It was spent at time zero, but over time, they don't write out that expense at time zero, but they just spread it over the next 5 years or something like that, right? So that actually in year 2, year 3, year 4, year 5, no expense was actually made. No expense was actually incurred. But since they didn't write out the whole amount in year 1, they spread it over the next 5 years or next 10 years. So in the following years, there was actually no cash, no cash outlay, no cash, no cash, expense incurred in the following years. But you still put it in the income statement and you match it with the it's also reflected in the balance sheet to reflect the depreciating value of your physical assets. So actually, during the second, third, fourth, fifth year, this is cash preserved, right? So cash preserved needs to be added back in. And that's the difference between operating profit and operating cash flow. And then investing in operating capital. Operating capital means what? Physical capital, of course. Physical capital is called fixed assets. So gross fixed assets and net working capital. What's net working capital? You remember current assets minus current liabilities. That's net working capital. Now that means if there's any change in the if there's any change in physical assets, right? If you need to invest more in the physical assets, where does the money come from? It has to come from this. It has to come from the operating capital. What if there is, uh, increase in net working capital? I mean, you need to increase the net working capital, meaning you need to increase the current assets more than current liabilities. Where does that money come from? It has to come from operating cash flow. So that's what is meant by it's actually a non-operating cash requirement. It's both operating and non-operating cash requirement. But the point is, uh, so there's cash generated beyond reinvestment needs. Reinvestment, right? Uh, so think about it. You need to have, you want this free cash flow to be positive. I mean, of course, any viable business, they must have it must be, um, their free cash flow must be positive. Otherwise, it's not a viable business. If it is negative, then you have to borrow or sell equity, sell new equity, right? In other words, borrow through bonds, sell bonds, or sell stocks, right? Okay, so that's free cash flow. But that definition will, so basically, value of the company, think about it. Value of the company is uh, the present value of all the free cash flows in the future, right? This is the concept similar to, you know, uh, the stock valuation model, all the discounted cash flow models that you have seen so far, right? Basically, all financial assets value is derived from its expected future cash flow. And so free cash flow at the end of year 1, 2, 3, and to the infinite future. But then you understand this will drop out because this will be a close to zero, um, discounted by some discount rate. But then here the discount rate is an interesting thing. Discount rate is an interesting. It's called weighted average cost of capital. Why is it called weighted average cost of capital? That I will, I think I will have to continue after the break. So it's like, it's not coming up, but it's, the time is, where's the, where's the computer? Yeah, 101. So we'll take a 10-minute and come back at 110. Okay. And please don't forget to clear all the highlighted cells in the free cash flow model. Okay. All righty. 10 minutes. All right, we're back. We're back. Um, so we, I wish I could have more time because this is a very interesting topic, but we simply don't have uh, enough time. I mean, uh, one good thing is we have the main lecture is there. As I said, collaborate session is only a review, reflection and review. So uh, studying the main lecture is a must, and all the main lecture videos are all there. So um, whatever I can't cover in the collaborate, it's already been done in the main lecture. Okay, so we'll have to. I just want you to go to the main lecture for the free cash flow model for the that example because we barely can finish. I guess the time left. What we can. So the next. I'm gonna close this. So our next um, topic is the risk and return part two. So you can go back to risk and return, and um, here I'm not going to spend too much time on normal distribution probability. So when we have um, random sample, meaning stock return like monthly, weekly, daily stock returns are random sample, random data. They just, from quarterly, there is, it's based on, the actual performance, right? It's based on the earnings data, actual performance, right? So the correlation is clear, but like from day to day, uh, a week to week, month to month returns are pretty much uh, a random occurrence. It's just like uh, uh, like drawing a red ball uh, from a sack of balls. There are if you have a sack of 60 balls, right? And any number that comes up, there will be number 1 through 60. And if you put your hand into that sack, blindfolded, and just pick one number, one ball with one number on it, it's going to be a random selection, right? So our stock data is like random data, random sample. Therefore, we could use uh, a simple average. We could use simple average to as the mean of the monthly returns, and so it should have this type of property. For example, um, the actual distribution may not be this neat. The actual distribution may not be this neat, but the uh, it would generally, as long as you have like there's some kind of uh, minimum, sample data, minimum data points, right? Minimum number of data points in the sample uh, to show to ensure normal distribution probability, normal distribution characteristics, um, uh, so that minimum requirement is 30. This is an empirical result. So if you have like 60 data points, it more than enough. It meets uh, the minimum requirement for normal distribution. Um, so the normal distribution properties are this. When you have a mean, that Greek character mu, that means a mean, right? And then sigma is standard deviation. The the probabilities for any return, I mean for the expected return, I mean next month expected return to fall, I mean actual return, the probabilities of actual return next month to fall within one standard deviation around the mean, which is the expected return, right? Um, uh, that probability is 68%, 68%, right? That means uh, with 68% so that means 34% um, each side. So there's a 34% probability that the next month's actual next month return is somewhere between one standard deviation, the mean, and one standard deviation above mean, and also 34% probability that actual return can be somewhere between one standard deviation and uh, mean minus one standard deviation, which is, look, let's see, Apple, where was our Apple? What was the mean? It was like 3.3%, wasn't it? That was, where did I put Apple? No, I must have put it. The downloads. Yeah, here. I'm gonna move this to. Okay. So our mean was what? The mean was 3.36. Standard deviation was roughly 8.5. So 3.36, so roughly 3.4, 8.5. And so that means we have now it doesn't allow me to draw on this thing, but so this is 3 point whatever, let's just 3%, 8%. So standard deviation 8%, 3% plus 8%. So this point will be 11%. And so that means there is a 34% probability that the actual next month return will fall between 3 and 11%. This would be -5 then. Also 34% probability the actual next month return will fall between 3 and -5. And also there is a 14% probability that the actual return will fall between 11% and 19%, right? It's 2 standard deviation above mean, so this would be like 19%. And then also 2 standard deviation below mean was 14% probability that the actual return will fall here, which is, the -5. This is -5, so -13, right? -13. And then the probability of actual return to fall out above, this was what? 3 plus 6, 19. Actual next month return to fall above like 19% or above 20%. That probability is 2%. 2%. And also, so in other words, extremely high return is rare. Extremely high return, like above 20% return, it happens only 2% out of the time, right? That's what it means. Also, the opposite is true. 2 standard deviation below, that's -13. So getting any low return like -14, -15, that probability is also 2%, right? That's the properties of normal distribution. But then, so our return shows this pattern. But look, later on you will see. So what is the risk is what? Risk is actually the volatility. I talked about this last time. Risk is actually the volatility of not only downside. I told you, if you get anything below the mean, that's the downside risk, right? But getting something above the mean is also called risk. This is upside risk. I mean, if you get something above the mean, like 6%, 8%, 10%, I mean, that's a pleasant. That may not sound like a risk to you. It's a pleasant surprise, but the surprise is always a risk. Okay, surprise. In other words, the fact that it is volatile, it is that volatile, right? With the 34%, with the 64% probability, right? The actual return will be anywhere between 11% and -5%. That volatility by itself is already a risk. Okay. So risk is not only. I'll close this. So deviation from the mean return, expected return, that's the risk. So we don't think about it. The risk can be, the distribution can be either like this blue pattern or the red pattern, red distribution. We can tell, yeah, the blue distribution has smaller variance. The red distribution has wider variance. So wider variance is always a higher risk, right? And if both distributions have the same mean, right? Both distributions have the same mean, then which one is better? Of course, the blue one is better because this is exactly the concept of mean variance ratio, right? Remember, Z was most preferred because mean variance ratio was the highest, right? That means clearly the blue distribution will give you higher mean variance ratio or return risk ratio. So the blue one is preferred. The red one is inferior because the return risk ratio would be lower. It's like a gas guzzler. You understand? um, big cars like Cadillac Escalade, or they get like, I don't know, 5 miles per gallon or 8 miles per gallon. Mhm. You take gas mileage, that's and uh, Toyota Prius, it gets like although Prius is hybrid, so obviously it gets 40 something miles per gallon or 60 miles per gallon. I mean, think about it. Mhm. Um, and this one is just um, when we just treat the data with as if they are not over time. I mean, just like if we treat the data like cross-sectional data or latitudinal data, it shows this pattern. But if we plot it, if we plot it along the timeline, it will show this pattern, right? Think about it. This is along the timeline, right? There's time. Uh, this one, there's no time. It's just plotting it basically uh, along the returns, right? Right. Uh, and this is probability, right? The vertical axis is the probability. But if you plotted the vertical axis as if you plot it like this, oh, where did it go? Where did it go? With the vertical axis, with the return on the vertical axis and the time on the horizontal axis, it would look like this. See, much less volatile, right? Blue distribution, the blue stock B, let's call it B, much less volatile. So it's preferred. As long as the mean is the same, it's preferred. Now, it's clear which one is preferred. But in this case, it's hard to tell which one is preferred because the mean is different. Now, stock B has higher mean than stock A, but its variance is much wider. Whereas stock A has lower, but variance is lower, also smaller. But then what do? Yeah, mean variance ratio, return risk ratio. You take mean variance ratio, return risk ratio, and that will settle the dispute, right? And what is and I also mentioned this before, difference between gambling and investing. In investing, uh, the distribution is, the mean of the distribution is always positive, right? Mean of the distribution is positive. Of course, you can have zero uh, return or negative return, but the mean is positive. So, whereas in gambling, uh, the mean is negative. There's no way. I mean, you may win. If you go to Las Vegas or Atlantic City and play the slot machine, you may win once after losing 100 times, right? After losing 100 times, you may win once. Therefore, the mean expected return is negative. But of course, you have a chance of ending up in like even more than 100%. Maximum loss, yeah, you lose all, negative 100%, right? You can lose all. In investing, also you can lose all, but then it's really, really outlier, right? Um, anything outside the 2% tail ends, anything outside this 2% tail end, because it has 2% probability of happening, it's called outlier. And to have like 1,000% return, that would be not even like 0.001%. The probability of losing 100% would also be uh, uh, very low, but still Uh, in gambling, you're more likely to end up losing, 100%. So uh, so we construct a portfolio, right? We will have to construct a portfolio. Um, and why? So I think I put, yeah. I'm gonna come back to portfolio later. So that risk is that volatility. You understand? Risk is that's total risk, but they come from. There are two sources of risk. Okay, in stock, remember, in stock there are two sources of risk. One is uh, systematic risk, and the other one is unsystematic risk. Systematic is actually, uh, they call it systematic, but it should be systemic, actually. Systemic risk. Systemic, it comes from the system. What system? The economic system. Macroeconomic system. Okay. And then there is unsystematic risk, uh, which comes from the inherent nature of that business and that industry. And this unsystematic risk can be diversified away. That means if you construct a diversified portfolio, right? If you construct a diversified portfolio, um, that means, at least 20 stocks from 20 different industries, not 20 stocks from the same industry, but 20 stocks from different industries. That's why it's called diversified portfolio. If you construct a diversified portfolio, these unsystematic risks will go away. So it's diversified away. They say diversified away, right? Unsystematic risk can be diversified away. Systematic risk is non-diversifiable. No matter how you diversify the portfolio, the systematic risk doesn't go away. Hence, it is non-diversifiable risk. Now, remember, do you remember, what are the risks in the bond? In case of bond, the risks are, first of all, default risk, right? And then inflation risk, liquidity risk, and then interest rate risk or maturity, interest rate risk or maturity risk or price risk, right? Now, of those four risks, and if you remember, I hope you remember, two are also systemic and two are unsystemic. What are those two? Think about it.
The inflation is systematic.
Yes, and that's great. Okay, EN, right? EN?
Yeah,
Yeah, EN. I'm gonna give you 0.5 for that. So let's think about it. There's, first, systemic. Two are systemic, and one is, inflation, right? Inflation risk. And the other one is interest rate risk, which is also called, maturity risk, right? Price risk or maturity risk. You must know them by different names. And then the other two, then, non-systemic, are default risk and liquidity risk. These two are specific to, each company, specific to each bond, right? Specific to each bond. But in case of stock, now There's also, let's take a look at the systemic risk. First of all, purchasing power risk. Purchasing power risk. Isn't that inflation? That's the same thing. Purchasing power risk is inflation risk, right? Because with inflation, purchasing power goes down. You lose purchasing power. Money loses purchasing power. And then interest rate risk. Yes. As interest rate goes up, right? The price of the stock, as with any asset, right? Bond, when interest rate goes up, bond valuation goes down. Stock price goes down. Bond price goes down because you're discounting with a higher discount rate. And that's why the market is, suffering. Market has been losing on a losing streak last week, the whole week. It's almost like, wow. They say 15%, Dow Jones. My portfolio lost almost, 10% from the highest point. 10%. Still better than, I did better than the market. Of course, I should do better than the market. Market lost, more than 15%, across the board. Oh, and so when is FOMC meeting? I mean, because of this, once the FOMC, after the FOMC meeting, no matter what they say, it will bounce back. It will bounce back, right? When maybe Federal Reserve may say something very conservative. I mean, they were signaling that rates are going to go up from March this year. So that was from the last FOMC meeting. So FOMC, I guess they are meeting what? Today's 24th. When do they meet? From today? Or it was already, the expectation was already built in. But why so, it's really overreaction of the market. It's not like expectation was not built in. But if the Federal Reserve says, we'll continue to carefully monitor, I mean, that's the language. We'll continue to carefully monitor before making the decision to raise the rate. I mean, considering this, drop in drastic, drop in the stock market, the Fed might take a more moderate posture. And then if the language is like that, then, the market will bounce back. Or no matter what they say. I mean, even if the Fed says, we're going to raise the interest rate from March, it's still the same thing. Once everything is more certain, then the market will market has lost enough, more than enough. So, and the economy is not bad. The economy is good. I mean, still below its potential GDP, still below its potential GDP. So there's a gap between the reality and the potential. So that means, economy can do better. I mean, the economy is doing as much as it can with the limited manpower it can mobilize. Because you guys know a lot of people retired. A lot of people took early retirement. So the unemployment rate is very low, but still, that's not, in terms of the number of people employed, right? In terms of number of people that are willing to work and and working employed, is still short compared to pre-pandemic era, because a lot of people took. That's why there is a gap between the potential GDP and the actual GDP. So the economy has room to grow. But anyway, Market risk, that means, financial market risk, of, coming from the financial market. Exchange rate risk, from the exchange rate. I don't have time to. The main lecture, in the main lecture, I explained, everything. Reinvestment rate risk. We already know what it is, we talked about it. Now, then what are the financial risks and business risks? I mean, is financial risk, isn't it? Aren't we all? This is finance. I mean, as long as you're in the financial market, aren't we all facing financial risk? No, it's more specific than that. Financial risk means, certain industries. This means, default risk. Actually, this is default risk. Default on the debt. Okay, this means default risk. Why? Certain industries are more prone to default than other industries. In other words, some industries are more prone to use debt financing, than other industries, more likely to use debt financing. And if you have higher percentage of debt, in other words, if the company is highly leveraged, that's another way of saying it, highly leveraged, meaning, company has capital structure. You remember capital structure? Capital structure of the company is more like 60% debt, 40% equity, 70% debt, 30% equity. Now think about it. I've been telling you that's very high leverage. I told you that the optimal capital structure is the balance. The optimal structure is found somewhere between 70 to 60% debt, which means 30 to 40% equity, like something like 65% equity, 35% debt. I mean, empirically and of course mathematically, we can find the exact optimal capital structure point. But empirically, it's somewhere between 60% equity, 60 to 70% equity, to 40 to 30% debt. But there are some industries that are prone to be highly leveraged. What are those? And in the main lecture, I gave you an example. It's airlines industry, and so I'm not gonna spend too much time on this because now, and the business risk is the risk that is specific to that business. For example, if you're in a restaurant or hospitality industry, you are more likely to be impacted by the weather. Isn't that right? If there is tornado, hurricane, of course, hotels, and you might say, you're not necessarily in Florida. I mean, how would hospitality industry get impacted? I mean, if you're in Florida, the hospitality industry will get clearly impacted, because, for example, if the weather is very unusually cold in Florida, I mean, which would hardly happen, or storms, hurricanes hit hard Florida, obviously less tourists. Also, if a hurricane hits orange farm, orange orchard in Florida, and the orange harvest falls drastically a particular year, then the price of the orange juice will go up. The orange price will go up. Orange juice price will go up. Restaurant industries generally will have to raise price, right? On whatever, contains orange. But anyway, that's specific to certain business. I mean, IT industry won't get hit by weather, right? But anyway, so the reason this is called, diversifiable risk means, as I said, risk gets diversified away. And when you have like 15 to 20 diversified sectors, right? Diversified sectors in your portfolio, right? The total risk goes down drastically, but the total risk cannot go down below this line, line AB, because line AB represents systematic risk. So what you can do is, now first we can, diversify away by so here's, what happens, so suppose we have stock A and stock B, right? Stock A and stock B, and they show, now you understand, and something like stock C. Now, well, what do they look like? Stock A and B. I mean, this is plotting the returns along the timeline. And the stock A and stock B are in complete opposite. Stock A and B are showing completely opposite trend. Completely opposite trend, right? That means when stock A goes up, stock B goes down. Stock B goes up, stock A goes down. And if they move in exactly this pattern, suppose you have 50% in stock A and 50% in stock B, what's going to happen? They're going to cancel out each other, right? They're going to cancel out each other, and you will have always this portfolio return, mean return, right? With zero risk, right? Because A and B, the opposite movements, cancel out the risk. Okay, the main lecture video explains, why mathematically why they are. In other words, variance is variance of the two stocks will cancel out each other, right? And when, just like stock A and B, when they move in opposite path, they are called to have negative correlation, and perfectly negative correlation. Okay? Perfectly negative correlation. The perfect negative correlation is -1, right? Think about it. If you have an identical twin, then you guys you are highly correlated. Isn't that right? If you are identical twins, then the twins will be highly similar, then highly correlated, right? The correlation coefficient would be almost like 0.99. 0.99. I mean, already 0.91. This is high, correlation, right? Your siblings, between you and your siblings, there's high correlation, at least more than 50%, higher than 50% correlation, right? The cousins would have maybe lower than 50% correlation, but still positive correlation. Think about it. Your siblings from the same parents, so 50% of your father, 50% of your mother, right? And you split it between the, the probability of the correlation between the siblings would be very high, but between cousins, it will be, your father's brother, so there's 50% there, and then the siblings are the result. I mean, your cousins are the results of your uncle and aunt who has no blood relation, or aunt and uncle who has no blood relation. Um, so your cousins would have 25%, right? Correlation. But anyway, it's just an analogy to make it easier to understand. You may not find, in reality, you may not find something like stock B. You may not find something that has perfectly negative correlation. But however, you may find something like C. C shows a positive correlation, right? It's not probably about 50% positive correlation or whatever. The correlation coefficient would be 0.5 or something. So you may not find, it's difficult to find the one with complete negative 1, correlation coefficient of -1, but you may find something with some negative correlation, probably very low, but it's easier to find something with some low positive correlation, less than 50%. Or the point of diversification is, think about it. Diversification means the sectors, you construct a portfolio, if possible, with the sectors, different sectors that have little correlation with each other. If they have high correlation, then your portfolio is not well diversified. You want to diversify it so that the variance would be very small. So variance of the portfolio will be very small. So if you find something like A and C, construct a, put 50-50 in each, or whatever combination. It could be 70-30, or and then if you construct a portfolio, the mean of the portfolio doesn't change. It's mean of the portfolio will be whatever the weighted average will be, but the variance would be much more tamed. The variance will be much more tamed, like the green curve, right? That's the reason for diversification. So here is the example I did. That was years ago, 2011, so the data, I got the data from 2006 through 2011. And different industry, look at these companies. Some of them are in the same industry or similar industry or related industry. Some of them have no correlation whatsoever. But look at the correlation. Correlation between Apple and Apple would have to be 1, of course. Google and Google, it has to be 1. Northrop, Northrop America, it's a company that makes, a defense industry, company that makes jet fighters. So DoD, Raytheon. Self-correlation is, of course, always 1. So this diagonal is self-correlation, And 5 years, including financial crisis, and 3 years after financial crisis, and look at the correlations between these industries. They are low. The highlighted ones are the ones with low correlations. But anyway, the point is, then we can diversify away the non-systemic risk. But what can we do about the systemic risk? Systemic risk is measured by beta. Beta is the correlation coefficient. Stocks beta measures this market risk. Market risk in terms of, in other words, it's the volatility uh, in relation to the market return. So beta measures individual, the correlation between individual stock and the market's return, right? So in other words, how much the individual stocks return moves in relation to the market return. So in other words, in general, S&P 500 dropped, let's say 5%. Okay. How much did my stock drop? And how much did Apple drop? If Apple dropped also 5%, the correlation between market return and Apple is just 1. That means Apple moves exactly just like the market. So and that means, if S&P 500 goes up 5%, we can expect Apple to go up 5%. Apple's return to go up 5%. If Apple's beta, if that's when Apple's beta is 1, if Apple's beta is 2, that means when market S&P 500 drops by 5%, Apple will drop by 10%. And when S&P 500's return goes up by 5%, Apple's return goes up by 10%, right? So in other words, the higher the beta, think about it. If beta is 3, that means when market drops 5%, Apple will drop 15%. And on the other hand, if S&P 500 goes up 5%, Apple will go up. Apple's return goes up 15%. So in other words, the higher the beta, the more volatile the stock will be. And Apple's beta is actually less than 1. I mean, or even before. I've been tracking Apple since early 2000s, like 2007, I believe, 2007, 2008. And even those days, Apple's beta was like 1.5. These days, Apple's beta is like 0.88. That means Apple was very wild stock, right? Apple was very volatile stock, 1.5 times more volatile than the market, even in 2008. But now Apple is a very tamed stock, very low volatility. It's not even, think about it. If beta is less than 1, that means when market goes up by 1%, Apple doesn't even go up 1%. It goes up by 0.88%. If beta is 0.88, and if market on the other, so that becomes a boring stock, right? It becomes a boring stock because the chances of abnormally high returns are very low. But still, it's possible, because there's 2% probability of the upper tail, right? 2% probability of outliers. But that probability is becoming like 2%. I mean, some stock that Apple back in 2008, 2007, the probability of abnormal returns, like 25%, was not that slim. It wasn't like 2%. It was more like rather uh, upper 5%, uh, upper 5% tail, uh, upper 10% tail, or whatever. Um, so here's the idea. I mean, oh, what did I do? You may you may remember we don't have time really. In middle school you may have done this. They gave you this data, x 1 2 3 4 5 6 20 data points, 20, and then y is 3.57, so on. If you plot it, right, um, those blue dots are the plots, right? When x is 1.5, x is 2, 3, 10.5, and they all fall on a straight line, neatly on a straight line. And they say this is a linear function. A linear function is fx, f of x, function of x, or y equals, 3.5x. Of course, look, they may have given you, beta already, 3.5, which is the slope of the this line. They gave you x values and beta, 3.5. Then y is automatically generated. 1 times 3.5, 3.5, 2, 3.5, 7. So then the result will be the plot, the coordinates between x and y. The plot will be just neatly on a straight line. Because it is, this is an artificial result. This is an artificial result. But, it was because y values were generated by beta, right? In other words, if they gave you a beta, then it's not difficult to generate y values, right? And they will fold neatly. But the reality isn't like that. Look, um, uh, the reality is, uh, suppose x is Apple, so kx is the return. I told you k means cost of capital. So that means in case of equity, it means cost of equity, meaning the return. Now I want to go on, but without break. But it's 2:03, and my voice, I cannot continue. I'm kidding. So let's take a 10-minute break. Let's take a 10-minute break and return at like 2:13, 2:15. Okay, I'm gonna wrap it up then. It's not something easily that can be covered. Okay, 10 minutes. All right, we're back. We're back. Uh, so in reality, think about it. Um, we're not generating y value, right? We're not. The reality is like this: x and y are uh, given, and we need to figure out beta. So in other words, beta is what? This is the slope is beta because slope is called beta because um, when we have a linear function, right? Linear equation, right? We have two parameters or two coefficients or two parameters. Parameters is correct. Two parameters. One is the slope of the curve, slope of the line. The other thing is the intercept of the line. But the thing is, we are not given the line. The line isn't given to begin with. There is no line. But what is there then? We have x and y values. We have x and y data plot. So what is x? X is the vertical horizontal axis. In our, in our example, x is the market return. X is the market return. Okay, X is the market return, and Y is the stock axis return, which the vertical axis is the individual stocks return. In our example, let's say Apple. So think about it. We are given uh, Apple's return with S&P 500 return. The data can be downloaded, right? We can download S&P 500 for the last 60 months, 5 years, which is the market, right? Market index. And we downloaded Apple's return for the last 5 years, monthly return. So we have 60 data points for Apple, 60 data points for S&P 500, starting from like January 2016, right? So they can make we can make a plot January, and this plot is not necessarily in chronological order. Whatever S&P 500 was in January 2016, whatever Apple's return was on January 16th, that's this. Whatever was. So in other words, we can get a plot, a lot of plot, right? 60 plots, 60 data points. And the thing is, we want to find what does it have to do with this, blue line. This blue line is called, security characteristic line, which is basically the trend line um, uh, of that stock, right? Trend line, how the stock is trending, right? In relation to the market, how Apple is trending in relation to S&P 500. Okay. So, of course, there can be, the lines can be. So this is, return on the market. This is a return on Apple, right? Return on Apple. And we have, these plots are all, it's called a scatter plot. Now, but, if the plot has certain trend, I mean, you see, in this case, the plot has some trend. It's not random. At least it's not trending. It's not trending this way, right? No, it's not trending that way. Clearly, it's trending. It's trending this way, isn't it right? Hmm?
Positive correlation.
Yeah, there's a positive. That means there's a positive correlation, right? It's called uptrending or upward trending or upsloping. Uptrending, upsloping, upward trending, right? That means that there's a positive correlation because when that means when x moves right to the right, y moves also up, right? That it shows that trend. Of course, there can be like then the trend line can be something like, oh, can the trend line be like this? Can it be like this? Yes, there can be like several trend lines that can be identified, but the one we want the best fitting trend line, and the best fitting trend line is this one. And some people might say, why? Because it's in the middle. It's the middle one. No, it's not because of that. Um, think about it. Oops. This one, the lowest, the one at the bottom, it can explain the dots in the lower part, but it's missing out on most of them. And just the same, this one can explain the upper plots, upper dots, but it's missing out on the rest of them, right? So the best fitting line is the one that can explain the majority, right? Actually, technically, it's called, ordinary least square method. Ordinary. So there's a lot of things that you don't know yet, but finance is not something that's like English 101. You understand? English 101. You already know. There's no technicality there. There's no technical thing. There's no brain needed in English 101. You can read and write. And then you think, oh, because this is finance 100, it must, it must be the similar level. No, there is like, 4 year. I mean, this level of reasoning ability, this level of technical understanding, that's something you get like at best in senior year, junior, and unless that means you must have been trained, already for the first 2 years in all math and statistics and everything, and then you are able to take finance 100 in junior year, right? So actually, but why you are not junior, you are at best upper sophomore. But think about it. BMCC is a 2 year school. If we wait for the prerequisites like in the 4 year schools, um, this course has to be taken in the junior year after meeting all the prerequisites. But in a 2 year school, you cannot wait. You cannot wait until you have met all the prerequisites. So this course has to be taught. It needs to be given. At least, if you have taken math 206, and then, think about it. No other prerequisites are required. And even the prerequisite, it's not even math 206. As long as you have done, like math 056, then you're allowed to take this class. So again, there's a huge gap. And also think about it. You think, English professors and, economics and finance professors are on the same level. No way. Look, it takes it takes a PhD. But English literature, the PhD in English literature, it's a joke compared to. Of course, I know they go through a lot of pain because it's not easy, and there's a lot of subjectivity. Because think about it, in those courses, in those disciplines, if you are like if you're not, I mean, some professors can have certain preference or bias, but in English literature, something like liberal arts, English literature, because everything, the work by itself is subjective, right? That subjectivity can uh, uh, it can come into play. Subjectivity can come into play in evaluating a student. The student's writing is not in certain style that is to the professor's liking. The student unfairly loses point, and there is no objective way. There's no objective way of telling what's right or wrong. Huh? But in something like STEM, math, science, engineering, technology, anything based on math, economics, finance, there's no way that kind of subjective evaluation can come into play, because either you get the right answer or wrong. You get it right or you get it wrong. It's objective. It's very objective, right? It's subjective. There's no way, certain, style or certain, accent is preferred, or certain, um, no matter how well you speak English or English language, or how poorly you speak English language, doesn't matter. No matter how well you write or how poorly you write, doesn't matter. I mean, it's better if you write better, right? If you write well, it's better than you're writing poorly. But it's something like this fun, this knowledge and understanding and reasoning, right? Ability. So you can get it right no matter how well you write or how well you speak, or how poorly you write or speak. Doesn't matter. Whether you get it right or wrong, it's all mathematical. There's just absolute objectivity in evaluation. So anyway, the point is, um, the ordinary least square, in other words, the squared term of the squared term of all the error terms. Now think about it. These are errors. I mean, if our the trend line goes like, so I told you, two things determine the characteristics of the trend line. One is the slope, which is called beta. The other, intercept, vertical intercept, which is called alpha. Think about it. You were in middle school, you learned, y equals alpha plus beta x. Maybe, you did it like in opposite order. Y equals, maybe you did y equals bx plus a. Now, bx plus a, this is, childish. This is, juvenile way. When you're mature, and when you're older and mature and smarter, more with more, brain capacity, you don't write it like that. You use, Greek characters for parameters. Alpha for vertical intercept, beta for slope coefficient, right? So that's why it's called beta. I mean, beta is not some magic term. It simply means it's the slope. It's the slope coefficient, right? Slope of the straight line, beta. Then think about it. I told you, depending on beta, right? Beta can take either, can be greater than 1, equal to 1, or less than 1. If beta is greater than 1, if beta is equal to 1, That means exactly when market return moves by 1%, Apple moves by 1%, in the same direction, right? Positive correlation. So beta can be less than 1, and if it is greater than 1, like 3, right? When market moves 1%, beta moves by 3% in the same direction. Less than 1, but less than 1 and between 0 and 1. So something like 0.5. If beta is 0.5, then what does that mean? If beta is 0.5, you can easily tell. Still positive correlation, but when market moves by 1%, Apple moves by just 0.5% in the same direction. On the other hand, beta can have negative. Beta can be less than. Beta can be negative. So if beta is negative, that means negative correlation. If beta is -1, they move in perfectly opposite direction, like the like where is it? Like A and B here. They move in opposite direction, right? So the point is, we need to question is, beta and alpha values are not given, because that's middle school. In middle school, they give you beta, and then you plug in X, automatically it will generate Y, and they will. There's no scatter plot like this. Everything will fold neatly on the straight line. But the reality is that this will be the pattern we'll find in the. If beta is 0, there is no correlation. In other words, you cannot find any pattern in the scatter plot. So the question is, how do we find beta? Of course, we can find beta by running regression. That's totally, but for in this on fnb100 level, there is no there will be no question that would be asking you to find beta. Beta will be given. So if beta is given, then think about it. Theoretically, this vertical axis, theoretically, in reality, is not so, but this vertical axis will have to be risk-free return. You understand? The vertical axis will have to be the risk-free return. Why? Because nobody can do any less than the risk-free return. Think about it. The return is a the return on the stock is the reward for taking the risk. I've been telling you over and over, right? The stocks give higher return. Stocks are supposed to give higher return than the treasury, return on the treasury. Return on the treasury is the risk-free. So think about it. Nobody can do worse than, in the financial market, nobody can do worse than the risk-free return. In other words, if you don't want to take any risk, then you can put your money in a CD or a treasury bill, 1-year treasury bill, right? Then your money is, guaranteed. And even if it is like 0.5% or 1%, that is, risk-free. That return is risk-free. I mean, return on the treasury, that's risk-free. So without any risk, so nobody can do worse than. So think about it. The stock's return cannot be lower than when market is zero. Think about it. This point is zero, right? This this is the origin. This point is zero, right? This point is zero for both market return and for stocks return. But because you cannot do, I mean, if you, the stock must pay at least equal to, because you cannot do worse than, lower than the risk-free return, the stock must pay theoretically at least when market is zero, market return is zero, stock must give you at least still uh, the risk-free return. So nobody can. So in other words, the vertical axis theoretically will have to be risk-free return. In reality, it's not. Reality, of course, it's when you find a trend line. How can it nicely? The scatter plots cannot nicely. The trend line of the scatter plot cannot nicely go through that risk-free return, right? But anyway, the point is then, because nobody can do, so our y is what? Our y, since nobody can do worse than risk-free return, um, actual return, right? The proper return on the stock on Apple is actually, think about it, RA, that's Apple minus RF, which is, since this alpha was there, right? If you move it to, but if there is still, even after, if alpha is greater than risk-free return, then there will be something still left. That would be wonderful. I mean, if there is a positive alpha even above risk-free return, that's a stock that gives you abnormal return. That's a wonderful stock, right? So anyway, but if this alpha is risk-free return, if alpha is exactly risk-free return, then if you take away the effect of the risk-free return, this will be zero, nothing there, and then beta times the market return must also, the proper market return should be like this. Proper market return should be RM minus RF, right? Makes sense? Then what is this? This is exactly another way of, I know we are past 2:30. What time is it? So think about it. Then this is exactly y equals beta x, right? Y. So therefore, if you want to find only the return on A, then we know what to do. Return on A is, you move it to the other side. RF plus beta times RM minus RF. Now this is called CAPM. This formula is called CAPM. What does CAPM mean? Capital Asset Pricing Model. CAPM. Now, if you please study the main lecture videos, because everything is explained in detail. Why it's called CAPM stands for Capital Asset Pricing Model, but it's a misnomer. Why? It sounds like this is the way to this is the equation, this is the formula to price the capital asset. No, This equation doesn't price the asset. Instead, it gives required return. What is the required return? Think about it. All of these formulas, right? We assumed, zero growth model, dividend over R, and golden growth model, V0, dividend T plus 1 over R minus G. And you think all of these were given. They were given, right? Well, to do those examples, they had to be given. But then, in reality, this is not given. Who gives that to you? Who are you going to ask? Who gives that to you? Of course, there's something called, some services that provide this data. They have Morning Glory and one more service. But if you are a finance major, you are a finance expert, you're a finance professional, then you should be able to calculate this required return, not get it from someone. I mean, they don't give it to you for free. It's a proprietary item. You have to pay to evaluate all the stocks. Are you going to pay for every? No, you can do this by CAPM and by and also beta. You should be able to calculate it. We don't have time for that, but if you're an expert, a finance professional, you should be able to find beta. But again, that will be all discussed in the Finance 300. Okay, it was briefly touched on in this, but all right, that's it. That's it for today, and that's it for this semester. Any questions so far? Any questions? Any questions? Hmm? All right, if you don't have any more questions, then good luck with your final. Good luck with your final, and have a great rest of winter break. If you're taking springs, it starts on the 28th, I believe. All right, have a great afternoon. Good luck with your final.
Have a good
Thank you,
afternoon.
Professor.
Thank you,
Bye.
Professor.
All righty, Angel, darling, have a great good luck, Kazuki, with your final, everyone. All righty, I'll stop sharing and stop recording and sign out.